Right now, while you are watching this, the deed to your house lists your name. Just your name. Maybe your spouse beside you. Pull the deed out of the drawer where you keep the important papers, the one with the metal clasp, and read it again. Robert and Linda, James and Margaret, whatever the names are. They are personal names, flesh and blood names. And that single piece of paper is the reason a family that built something across 40 years can lose half of it inside 18 months when something goes wrong. The families with real money, the names you have heard your whole life, they do not own a single significant asset in any personal name. Not the houses, not the stock, not the businesses, not the land. They have not done it that way since 1882. And what I'm about to walk you through is not legal advice. It is the documented public record of how the structure works. I want to take you back to a specific room. Cleveland, Ohio. 19 Standard Oil entities scattered across 9 states, each one separately incorporated, each one technically owning its own refineries and pipelines. And John D. Rockefeller and his attorney Samuel Dodd standing in front of a wall of paper trying to figure out how to hold them together legally without putting them in one personal name. The year was 1882. Samuel Dodd drafted what is now considered the first modern holding company structure in American history. He called it a trust. The shareholders of all 19 companies signed their stock certificates over to 9 trustees, and those 9 trustees held the legal title for the benefit of the original owners, the Standard Oil Trust. That single document changed how American wealth was held forever. 29 years later, in 1911, the United States Supreme Court ruled in Standard Oil Company of New Jersey versus United States that the trust had to be dissolved into 34 separate companies. But the lesson Rockefeller had taught the rest of the country could not be undissolved. You do not hold the asset in your name. You hold the right to benefit from the asset, and a separate legal person holds the asset itself. Now let me jump forward. Bentonville, Arkansas. The year is 1953. A man named Sam Walton, 35 years old, walks into the office of his attorney with one variety store and a tax problem. He sits down and he divides his retail business interest between 5 people in his family. 20% to his wife, Helen. 20% to each of his 4 children, Rob and John and Jim and Alice. The youngest child, Alice, was 4 years old at the time. 20% to himself. He did this 17 years before Walmart went public. He did this when his children could not even read the documents they were given shares of. In 1969, he restructured the entire holding into what would eventually be called Walton Enterprises. The Mars family had already been operating their candy company through a privately held family structure since 1911, refusing to take it public no matter how much money was waved at them. Fred Koch died in 1967, and his sons Charles and David spent the next decade restructuring Koch Industries through a holding company architecture that allowed the family to retain control without holding the operating assets personally. Every single one of these families learned the same lesson Samuel Dodd wrote down in 1882. Probate will eat you. Estate tax will eat you. A single lawsuit will reach into every account in your personal name and pull what it wants. A creditor with a judgment can attach what sits in your name. None of these things can touch what does not sit in your name. I have spent months reading SEC filings and state corporate records in Delaware and Nevada and South Dakota, sitting at a desk with IRS Form 1041 trust returns and IRS Form 1065 partnership returns, spread out in front of me. And the pattern is identical across every family that has held wealth for more than 2 generations. 3 entities, always 3. And right now, I am going to name them. The classic 3-entity stack works like a pyramid, and you read it from the bottom up. Layer 1 is the base. It is the family limited partnership, what attorneys call an FLP, or in modern practice, a family LLC. FLP simply means a partnership where the partners are members of the same family. The FLP holds the actual operating assets, the real estate, the stock portfolio, the interest in the business, the mineral rights. The whole pile of valuable things sits inside this one base entity. The relevant tax code sections are Internal Revenue Code sections, 2701 through 2704, which govern how the IRS treats valuation discounts when you transfer interests in an FLP for gift and estate tax purposes. Section 2704 was added by Congress in 1990 and went into effect in 1991, and that is the year the modern FLP structure exploded across estate planning offices in this country. Before 1991, the structure existed, but the rules were unclear. After 1991, the rules were written down, the courts began testing them, and the architecture became standard. Layer 2 sits on top of the FLP. It is an irrevocable trust. Irrevocable means you cannot take it back, you cannot undo it, you cannot change your mind. The grantor, that is the person who creates the trust and funds it, gives up legal ownership of what goes inside it. In most billionaire stacks, this is structured as a dynasty trust, or as what attorneys call an intentionally defective grantor trust. Dynasty trust means the trust is designed to last for multiple generations, sometimes 100 years or more, sometimes forever, depending on which state you set it up in. Nevada, South Dakota, and Delaware allow perpetual dynasty trusts. Intentionally defective sounds like an insult, and it is actually a feature. The trust is structured so that the grantor still pays the income tax on what the trust earns under IRC Section 671, which contains the grantor trust rules, even though the assets are no longer in the grantor's estate for estate tax purposes. Section 643 governs the income taxation of trusts. Section 2702 governs special valuation rules for retained interest. The irrevocable trust at Layer 2 owns the limited partnership interests of the FLP at Layer 1. The trust is the limited partner. The grantor's children, or the grantor and the grantor's spouse, serve as the general partner of the FLP through a separate small entity that holds 1% or 2%. Layer 3 sits on top, or beside, the trust. It is an operating LLC for active business activities, paired with a holding LLC for passive investments. The operating LLC is what writes the checks, signs the leases, hires the employees. The holding LLC is what owns the stock and the bonds and the parking lot in Tulsa. These are the entities the public sees on the courthouse records. The public never sees the trust above them. The public sees an LLC name. That is the design. Let me contrast it concrete so you can see what I mean. Your house deed reads Robert Henderson and Linda Henderson, husband and wife. Their house deed reads Bell Tower Real Estate Holdings, LLC, owned by the Whitcomb family, 1987 Irrevocable Trust, John H. Whitcomb III as trustee. Same house, same neighborhood, same property tax bill, completely different legal reality. If Robert and Linda get sued, the plaintiff's attorney sees a house worth $600,000 sitting in their personal names and files a lien. If the Whitcombs get sued, the plaintiff's attorney sees an LLC with no obvious owner, has to pay a forensic accountant to trace the ownership, eventually reaches a trust that was funded 38 years ago, and whose terms the plaintiff has no standing to break. And frequently, the attorney gives up before the file is closed. Walk through the mechanism with me step by step. Step 1. The grantor forms the family limited partnership. The parents are the general partners with a 1% ownership stake and full management control. The children are the limited partners with a 99% ownership stake and no management control. The parents decide what gets bought and sold. The children own most of the value. Step 2. The grantor gifts limited partnership interest to the children or to a trust for the benefit of the children. Because the limited partners have no control and the interests are not marketable on any public exchange, the grantor claims a valuation discount under IRC Section 2704. The discount is typically 25% to 40% off fair market value. $1 million of underlying stock becomes a $600,000 gift on paper. Step 3. The limited partnership interests are placed inside the irrevocable trust, removing them from the grantor's estate forever. Step 4. The trust is structured as a grantor trust under Section 671, so the grantor continues to pay the income tax on what the trust earns. That sounds bad until you realize that income tax payment is itself a tax-free transfer of additional wealth into the trust, because the trust would otherwise pay that tax out of its own assets. Step 5. The operating LLC manages the actual business or property, and the holding LLC owns the passive investments. The trust owns the limited partnership interests in the FLP. The FLP owns the LLCs. Nothing sits in the grantor's personal name except a checking account and a pickup truck. The legal framing is built on real court cases that you can pull up tonight if you want to read them. Estate of Strange versus Commissioner, Tax Court Memo 2003-145. The IRS won that one because the grantor had used the FLP assets to pay personal living expenses, treating the entity as a piggy bank. The tax court pulled the assets back into the estate and the family lost the discounts. Estate of Bongard versus Commissioner, 124 Tax Court 95, decided in 2005. Another IRS win on bad facts. Murawski versus Commissioner, Tax Court Memo 2008-74. The family won that one because the facts were clean. The formalities were respected. The entity had a real business purpose. The pattern across 40 years of litigation is the same. Respect the entity formalities or lose the protection. Treat the FLP like a separate legal person. Keep separate bank accounts, hold annual meetings, document the resolutions. Do not pay personal credit card bills out of the partnership account. The catch, and there is always a catch, is that the setup costs real money and the maintenance costs real time. A properly drafted 3-entity structure runs $5,000 on the low end and $30,000 on the high end, depending on complexity in the state you set it up in. annual maintenance, tax returns for the trust and the partnership, and the LLCs, registered agent fees, state franchise fees, accountant fees, runs $3,000 to $7,000 a year. And if you ever treat the structure as a sham, if you ever use the entity bank account to buy groceries, the IRS or a creditor can pierce the whole thing, and you lose every protection you paid for. Let me tell you the Walton case in detail, because it is the cleanest worked example I have ever seen in the public record. April of 1953. Sam Walton, age 35, sat down at his attorney's desk in Bentonville, Arkansas. He owned one Ben Franklin variety store he had been operating since 1945, and a second store he had just acquired. The variety store interest was worth, in the records I have read, somewhere around $50,000 at that point. $50,019.53. He divided that ownership interest 5 ways: 20% to himself, 20% to his wife Helen, 20% to his eldest son Rob, who was 9 years old, 20% to his second son John, who was 7, 20% split between his younger son Jim, age 4, and his daughter Alice, who was also 4. Each of those 20% interests at that moment was worth $10,019.53 on paper. Probably less after the lack of control discount. Walton then restructured in 1969 into what became Walton Enterprises, a family partnership entity, just before the company went public. Walmart went public on October 1st, 1970, at $1.65 per share. The IPO valued the company at $135 million. The family's 20% stakes that had been worth $10,000 apiece in 1953 were now worth roughly $27 million each. Today, Walmart is worth more than $700 billion, and the family's combined stake, held through Walton Enterprises, LLC, and the Walton Family Holdings Trust, is estimated by Forbes at approximately $250 billion. That makes the Waltons the wealthiest family in America by a significant margin. And here is the part that matters most for this video. When Sam Walton died on April 5th, 1992, the IRS valued his personal estate at zero or close to zero. There was nothing left in his personal name worth fighting over. The wealth had been moved out of his personal name in 1953, 39 years before he died, when the variety store interest was worth $50,000 in total. He did not wait until he was rich. He set the structure before the structure had anything significant inside it. By the time the wealth arrived, the structure was already in place to catch it. That is the lesson. You do not build the dam after the flood. You build the dam first. Now look at the kitchen table in Akron, Ohio, 1965. A working couple sits down with their savings book and a deed to a small house on Goodyear Boulevard. Everything they own is in 2 personal names. The house is in 2 personal names. The savings account is in 2 personal names. The car is in 2 personal names. There is no FLP. There is no trust. There is no LLC. There is no holding company. 20 years pass. The man slips on his neighbor's icy porch in February of 1985 and breaks his hip. The neighbor's homeowner insurance pays the medical bills, and that is fine. But the same year, a different problem. He co-signs a loan for his brother who runs a small business. The business fails. The bank sues both signers and gets a judgment for $68,000. The judgment attaches to the house, attaches to the savings account, attaches to the car, because every one of those things sits in a personal name. The couple sells the house, pays the judgment, and starts over at age 62. Now imagine the same couple in the same year with the house held inside an LLC owned by a revocable trust, and the savings inside a separate brokerage account titled to the trust. The judgment can still pursue the personal signer, but the assets it can actually reach are different. If you slip and fall on your neighbor's porch in 2026 and your neighbor sues, every asset in your personal name is reachable. If you are sued for any reason at any time, every asset in your personal name is reachable. The Walton family's assets are not in any individual Walton's personal name. They cannot be reached by suing a Walton individually, because there's nothing in the Walton individual's name to reach. That is not a trick. That is a structure. That structure has existed in the same architecture since Samuel Dodd drafted it in Cleveland in 1882. And the difference between the family that keeps what they built and the family that watches it disappear in a single lawsuit, a single probate, a single tax event, is whether the structure was set up first. I am not your attorney. I cannot tell you what to do with your specific situation. But I can tell you the conversation to have, the doors to walk through, and the rough order of the costs, all of which is in the public record. The entry door for almost every family is the revocable living trust. Revocable means you can undo it. The revocable living trust is not asset protection. It does not stop a lawsuit. It does not stop estate tax. What it does is avoid probate. Probate is the public court process that transfers your assets after you die. Probate in many states takes 9 to 18 months and costs 3 to 7% of the estate. A revocable living trust avoids that entirely. Costs to draft $1,500 to $3,000 with a competent estate attorney. Layer 2 is the family LLC, holding investment real estate or a small operating business. Costs to form $1,500 to $5,000, depending on the state and the complexity of the operating agreement. The family LLC is what gives you a layer of liability separation between you personally and what the LLC owns. Layer 3 for most families is the irrevocable life insurance trust, called an ILIT, which holds your life insurance policy outside your estate, so the death benefit is not subject to estate tax. Cost to draft, $2,000 to $4,000. The 3-tier minimum for a structure that produces meaningful asset protection and estate planning starts to make economic sense at roughly $300,000 to $500,000 in total assets. Below that level, the legal cost eats the benefit, and a simple revocable living trust by itself is usually the right answer. The conversation to have with an attorney sounds like this. Ask about a family LLC owned by my revocable living trust, with my life insurance policy held in a separate irrevocable life insurance trust. Those 18 words tell the attorney you have done your reading and you want a real structure, not a one-page will and a handshake. The 3-entity stack is what every family that still has money in 2026 set up decades ago. Standard Oil set it up in 1882. The Waltons set it up in 1953. The Mars family had it operating before the First World War. The Kochs reorganized into it after Fred Koch died in 1967. The names change, and the industries change, and the dollar amounts change. But the architecture has been the same for 144 years. 3 entities. Operating LLC at the front, family LLC or family limited partnership in the middle, irrevocable trust on top. Nothing in any individual personal name except a checking account and a pickup truck. The families that did this kept what they built. The families that did not, the families I read about in old probate court records in county courthouses from Ohio to Texas, lost what they built within 1 generation, sometimes within 18 months. If you want me to walk through the next conversation, the one you have with the attorney, when you actually sit down at her desk, write in the comments, "I want the next attorney meeting." I read every comment on this channel. In the next video, I am going to open the door on the first entity, the Irrevocable Living Trust, and walk you through the exact questions to ask and the exact documents you should walk out of the office holding. That is enough for today.